with our guests, Adrianne Yamaki from Strategic Wealth Capital and Bob Elliott from Unlimited Funds. Welcome to you both. Happy almost September. Bob, do you believe this market rally, or do you think things are still too expensive?
Well, I think we are seeing the effects of pretty good growth data. You know, if you go back at the employment report almost a month ago, we had a bit of a growth scare, and that employment number, the unemployment number, looked a little high relative to all the data that we were seeing. And since then, we've basically seen further confirmation in other data that the economy continues to plug away pretty well. And that scare probably was overstated. I think the thing that's interesting is we got stocks back to highs, but bond yields still haven't really recovered from that growth scare period. And I think that's really where the gap in the market is right now, where those bond yields still look a little much like they're pricing in too many cuts over the course of the next 12 months relative to the strength of the economy that we're seeing in the data.
Adrianne, what do you have to believe about the economy, maybe about what the Fed's going to do, to think you should be buying in to the market here with the S&P just shy of 5650?
Good to see you again, John. It's interesting because if we're thinking about the upcoming jobs report, so usually we look at how generally when we want a jobs report that's fairly strong because there's an inverse relationship to stock market and unemployment. But there's a reason that this particular report, which is on the 6th of September, is going to be significant. And that is that it is about a week and a half before the next FOMC meeting. And what that also tells us is, so in July, we saw unemployment tick up a small, tiny amount to 4.3 from 4.1. But it's actually in the bigger picture. So normally we would think that would be negative, but it's actually very positive for stocks because of the upcoming FOMC meeting. It gives the Fed a little more space to be able to lower interest rates, and markets are looking very carefully. In addition, it's also the last FOMC meeting before the election.
Bob, I want to go back to something you just said, because Treasuries just had their longest monthly winning streak in 3 years. So you think yields need to go higher from here, even with a Fed that's poised to start cutting? Well,
the question when you're buying bonds today is not whether the Fed's going to cut or not. The question is, how much do they cut relative to what's priced in? And right now, we've got relatively aggressive cuts that are priced into the market, the sort of cuts that you typically see during a recessionary environment. 200 basis points over the course of 12 months. We saw that in the depths of COVID, the depths of the GFC, and the depths of the tech bust, 25 years ago. And so I think the real question is, are they really going to deliver those sorts of cuts when you see, growth measures that are, 3% real growth ongoing basis, roughly 3% consumer demand? Those are very strong numbers. It's not really necessary to be cutting at a recession-like way when you're seeing growth numbers that are holding up that well. So do you steer clear of fixed income, at least in the near term, maybe because there's a correction brewing there, and pile into equities, or you see it differently? Well, I think there's, equities pushing back to new highs with earnings growth expectations in the mid-double digits as you move to 25. It's certainly rich, very high expectations there. So I'm not sure the lesson here is to dump bonds and pile into stocks. More, be careful of the duration exposure that you've got, and be cautious and probably more of a picker's market in stocks than buying the index here.
Adrianne, how closely are you going to be watching the consumer spending trends toward the end of the year, particularly holiday, as there have been questions about now the full range of incomes and how the consumer is holding up?
Well, if we're looking at, for the next couple of quarters, it's going to be really hard to know because there's a lot in the mix in terms of what is the Fed going to be able to attain a soft landing? And one reason that I care so much about not just what's going to happen with the interest rates, but what the labor market is for businesses, labor is one of the most expensive components. And most affects their profits pretty substantially. So rent and labor. And ultimately, those costs get passed on to consumers. So as someone who owns a private practice in wealth management, a slightly softening labor market can be very positive because we don't have to pay as high a premium to attract quality quality workers and quality employment, and that's the case across many different sizes of company. So that ultimately will be affecting how consumers spend and pricing. And one thing that we'll see at the end of the year too, with the election, is depending on the party which is in power, whether tariffs are another thing that gets added to the mix, which is also inflationary and can soften demand and consumer spending as well. So there's quite a lot to look at in the next few months.